Hey, I'm going to start the presentation because we're expecting over 100 more people than who's already in here. We did this cute little poll, and I'm going to fire it up. Start the poll. There are 900 million dogs in the world. What percentage of them are domesticated? On the right side, if I publish, on the right side of your screen, you can click this. And this was a brilliant question asked by my 5-year-old. He's in the season of life where he asks questions like, Daddy, how many baseball players are there? And then because I'm a numbers geek, I'm like, that is a really good question. So he asked, how many dogs are there in the world? And if you follow me on Facebook, you already know the answer of this question. But how are we going? We're trending towards 50% of the dogs are domesticated. 40%. All right, I think that's good enough for an answer. 20% of the world's dog population is domesticated. That means 80%. So if you answered 20%, you were right. That means 80% of the dogs who walk amongst us throughout the world are either feral or stray. And I think they added dingoes to the dog population. So, you know, dingo is like an Australian coyote type thing. So, all right, y'all didn't come here to talk about dingoes, but let me get the presentation going. And we'll talk about capital markets, which is something I can speak eloquently on. All right, start the presentation. And we're going to start it from, start from here. Oops, I might have to go back to the beginning because I ran through it. Sorry, everyone. It's like watching a parade in reverse. I'm spoiling the surprise at the end of the presentation. Brittany and Nikki, this is a learning moment for us right now. All right. Oh, okay. Here we are at the beginning. All right, cool. Most important, here's our little compliance slide. So everyone can read every last word of that. Kidding aside, the SEC and Joe Biden's SEC, there's been a number of changes to the paperwork that we need to populate. And it's frustrating from my seat as a small business owner because oftentimes we're going back to individuals and basically having them sign the same form that they already signed a couple of years ago, but it just has some different language within it and some additional forms on top of that. So I'll warn you right now, if you work with our firm, when you get together with us, we might ask you to stretch your hand because you need to sign a couple extra forms. But, you know, staying in compliance is important to us because otherwise we don't want to have a bunch of regulators and people knocking our door down saying, hey, why didn't you have people sign this form and that form? But just word of warning, that is the SEC we're dealing with right now. More forms, more signatures, and we are going to do what they tell us to do. So, okay, so this slide's a couple weeks old now, and you could tell it's a couple weeks old based by what the S&P is up year to date. The S&P has been on a tear the last few months now, and certainly the last few weeks. I think people are breathing a sigh of relief because, you know, 2022 was ugly. The S&P was down close to 20%. The NASDAQ was down over 30%. And year to date, some newspapers are already calling for the 2023 bull market. Year to date, we're up about 13%, depending on which day or minute you look at it. So I think people are starting to think, okay, we're out of the woods. All that ugliness that we saw in 2022 is over. And now it's time to pile back in the stock market and make outside returns again. I happen to think we're in what's called a secular bear market. A secular bear market is characterized by a prolonged period of time with pops and drops in the market and a periodic rug pull. So you're going to see chop, but you're going to kind of squint your eyes and take a step back and go, boy, we haven't really moved anywhere. The market's been stuck in the muck. And that's what I'm experiencing right now. If you look at the S&P 500, we're basically where we were April of 2021. So darn near 2.5 years, the market really hasn't moved much because we spent most of 2021 upward, most of 2022 downward, and now here we are in 2023 kind of finding our way back to where we were in 2021. So I think we're in what's called a secular bear market. Maybe a more troubling line in this graph is the light blue line. That's ticker BND, a total bond index. And typically bonds have been a safe haven for retirees. Usually if you had 60% of your portfolio in equities and 40% in the bonds, you would be somewhat isolated from major market pullbacks. You can see bonds, because interest rates have gone up, even bond indices were down double digits in 2022, and they really haven't recovered because interest rates haven't dropped precipitously here in 2023. So it's a tremendously challenging market, even though you might be seeing some headlines saying, hey, the S&P is doing great. I'll give you another statistic. The S&P 500 is the 500 biggest companies in America. It's actually the 510. I don't know why they don't name it the S&P 510, but if you were to pull out the 5 best performing stocks in the S&P 500, and of course, those 5 best performing stocks all have like an artificial intelligence leaning to them, the S&P 500 is almost flat year to date. So you pull out the 5 best stocks of the S&P 500, the S&P 500 is not performing nearly as good as the overall index would tell you, being up 13%. So it's been really kind of a stock picker's market. Just a few of the best names at the top have been really leading all of the growth within the entire index of 510 companies. Here's a bingo game that you do not want to be playing. Bankruptcy bank bingo. My wife is addicted to bingo. We go to her grandmother's independent living facility, and we take our kids and we play bingo with the professionals. We actually got asked to not play any longer. And I think it was probably because of 2 reasons. One, we have our hearing and our vision. So I think we were winning a little bit more often because we were actually hearing the numbers called and properly marking our cards. Or maybe it's because of my feral boys. My 5-year-old and 4-year-old run around causing havoc. So they said, hey, you're winning a little too often, and you bring with you a level of chaos we didn't ask for here. So we're no longer allowed to play bingo at Daniel Point Retirement Facility. But kidding aside, literally in a 2-month time period, this slide says 2 months ago, but it was really 3 months ago at this point. In a 2-month time period, we witnessed the 2nd, 3rd, and 4th biggest bank failures in American history. And this market basically shook it off. Now, the reason it shook it off is because the Federal Reserve and the Treasury and the FDIC came up with a program called the Bank Term Lending Program, which in essence was a blank check to all the regional banks. It said, hey, if you have government treasuries on your balance sheet, we're going to make you whole on any of the losses that you sustain from having to sell those at a loss because interest rates went up. They also said the same thing about mortgages that were on their balance sheets as well. So the government bailed out all the regional banks. And of course, what happens when the government bails institutions out and prints money? The market goes up. And I think that's what you're experiencing right now. But to put these failures into perspective, in 2008, during the financial crisis, we had 150 banks go belly up. These 3 banks had more assets than all of the bank failures in 2008 combined. This is a massive, cataclysmic economic event that we're kind of just brushing off like, oh, this is what happens. Banks fold up every now and again. These are very, very big regional banks. I don't think we're out of the woods yet. The Bank Term Lending Program is due to expire at the end of the year. They're going to have to re-up it. I think we're going to see more regional banks fold up because we're seeing lots of people pull their money from the regional banks and putting it either in government-backed treasury money markets that are yielding over 4%, or the high yield money markets online where you can get significantly better rates of return on your money and FDIC insurance, or people are pulling their money from the regional banks and putting them in the big four banks. I know a lot of business owners are electing to do that. And business owners, look at our little rinky-dink business. I bank with one of the big four banks because my deposits are regularly over FDIC limits, and I can't flirt with seeing my bank on the nightly news because the FDIC took over. Secondly, with the regional banks, most commercial real estate is written and underwritten by regional banks. And commercial real estate is in a tight spot right now, not so much here in Charleston or in Myrtle Beach or just in the South in general, but in big commercial real estate epicenters, think San Francisco, Chicago, New York, there is a tremendous amount of vacancies in those cities right now. Close my email so it doesn't make noise. There's a tremendous amount of vacancies as people leave cities and no longer want to work inside of an office building. Couple that with the fact that most all commercial real estate is adjustable in nature. Every 5 to 7 years, a commercial real estate loan is going to reset to current interest rates. And because interest rates have gone up so much, we've got this perfect storm of commercial real estate loans resetting to significantly higher rates. People who own these office buildings were paying a 4% interest rate, and they're all going to reset to more like 8 or 9%. Couple that with the fact that their building is now 60% vacant, whereas when they initially took the loan out, it was 100% occupied pre-COVID. So a lot of people are saying that's a perfect storm for disaster with the regional banks as commercial real estate loans reset to current interest rates and owners make business decisions to walk away in many cases. And a lot of those properties are owned by LLCs. So, people might start going strategically bankrupt, which would cause more regional banks to have to sell bonds at losses. And as you've come to see, the commercial banking crisis kind of spread like a contagion. As soon as we saw Silicon Valley Bank fold up, very quickly behind them, we saw Signature and First Republic and Silvergate. And then all of a sudden you started hearing names like PNC and Regions and Truist, some of the more regional banks that were getting coupled in there, even though that they had really nothing to do with the circumstances which lent itself to Silicon Valley Bank folding up. So I don't think this narrative has gone away. I think you're going to see a lot more of it as the year plays out, and certainly into next year as well. I like this slide. Newspaper recently, or the nightly news did a question where they said, is inflation affecting your family? Only 124% of the public said no, but 195% said yes. I think you're going to see more headlines like the one at the bottom here. This is from CNN Business. It's saying inflation fell for the 8th straight month in February. It actually ticked up in March and April and ticked down in May. So inflation, unlike the analogy I use is if you're here in coastal South Carolina, you're no stranger to a named storm headed our way. And anytime we have a hurricane and we're in the path of its destruction, Jim Cantori comes to town. He stands in a puddle and tells everyone that the city of Charleston's underwater, or, Conway's underwater. And there'll be that graphic where they show the potential height of the storm surge, where they'll say, hey, this storm surge is going to reach 10 feet. And everyone freaks out because it's terrifying to think of the amount of destruction that a 10-foot storm surge would cause. But we also recognize with a hurricane, storm surges go away with the changing of the high to the low tide every 6 hours. We also recognize that hurricanes devastate an area and then they're gone a day later. Inflation is very different. Think of the high watermark inflation hit in 2022. it was over 9%. So now you're starting to see that high watermark slowly recede. But we still have inflation readings over 6%. So unlike a storm surge that goes away very quickly, inflation surges linger and last for months and years on end. Also, unlike a storm surge, inflation as it lingers has a profoundly negative impact, mainly on middle-class Americans. Household incomes of $100,000. So you've got a husband and a wife working, or a husband or a wife working, making 100 grand. And you see what hits that bank account after FICA taxes, after healthcare. It doesn't take a rocket scientist to understand that people's purchasing power has eroded dramatically over the course of the last couple of years. There is less discretionary money to buy plastic crap. And plastic crap is ultimately one of the fuels of the American economy. So if people's paycheck is now being disproportionately allocated towards needs, and there's less discretionary money to blow on wants and fun stuff, naturally that's going to be an anchor on the economy. I think the dog whistle that's going to be sounded to the people who would like to have us believe that inflation is under control is this headline at the bottom. Inflation fell for the 8th straight month. And certainly that is something to be celebrated. I'd rather see inflation go down than up. But to think of how ugly it was, naturally you're going to see inflation recede a little bit. But I think we're still going to be, the middle class in particular, are going to continue to be negatively affected by inflation well throughout 2023, well throughout 2024. And wage growth has not kept pace with inflation in the slightest. Funny thing that happens when you print $8 trillion in the heart of COVID, it has a negative impact on middle-class Americans. So I think this is another reason why we're going to be stuck in a secular bear market. Regional banks are still against the ropes. We have inflation numbers that haven't gone away. Maybe to get a little less political, because I know sometimes people can accuse me of being political with some of my viewpoints. Let's just look at the yield curve, okay? So the yield curve doesn't have a political leaning to it. It's purely what people are willing to lend money for. And a normal yield curve would tell us that the longer you lend someone money, the higher the interest rate you'd expect on your money. All right, so conventional wisdom would say if you're going to lend someone money for 10 years, you ought to get a better interest rate than if you lend someone money for 6 months. Because in 6 months, you get all your money back and you move on with your life. 10 years is a long time to lend someone money. You ought to be rewarded for that longer holding period. And that would be indicative of a normal yield curve, the blue line here. Longer the time, the higher the yield. We have what's called an inverted yield curve right now, meaning if you lend the government money for 6 months, you get a higher interest rate than if you lend money to the government for 5 years. It defies logic, but that is the world that we live in. The last 10 recessions have been precursed by an inverted yield curve. It is probably the most accurate leading indicator economists have at their disposal. 90% of the time we have an inverted yield curve, we are either in the first or second inning of a bad recession, or we're going to fall into a very bad recession. So literally, if you're a betting man or woman, politics aside, thoughts of Joe Biden and all the crap that's going on the nightly news aside, the yield curve is telling us that we're either in the first or second inning or we're about to fall into a very bad recession. And if you're a betting person, there's a 90% probability that that is probably going to transpire. The yield curve is inverted. The bond markets are pricing a recession in. And this happens to be one of the biggest inversions I've seen throughout my career, which is now close to 20 years. Even when you look at the yield curve inversions that we experienced in the history books, we haven't seen anything quite as exaggerated as what we're dealing with right this very minute. This is a question that I get from talk radio types more than anything, but gosh, darn near once a week, I get a email or a phone call where people are asking, Adam, what do we do if the dollar loses its global reserve currency status? And I know I just started this presentation out on a real pessimistic note. Maybe this will be more optimistic or encouraging. So this is something I don't think you need to worry about. Still yet, 84% of global trade is conducted in the US dollar. Almost every single meaningful commodity that gets exchanged worldwide is priced in US dollars. Second place is the euro. Yet everyone seems to be chirping about how the Chinese are eating our lunch and the Chinese yuan is going to be the reserve currency of the future. And look, no doubt the trend line is up and to the right for China and down and to the right for America as a global world order superpower. America is losing its spot on its throne as the largest economy in the world. And I think you're going to see more international trade get conducted in foreign currencies, but we still have a massive majority. In fact, it's taken us, 80 years from the Bretton Woods Agreement after World War II to become the world's reserve currency. I don't see that changing in my lifetime. I don't see that changing in my kids' lifetimes. You'll hear the gold bugs talk about how the dollar is losing all of its value. Even the Bitcoin guys are doing it now too. So what this means is when Brazil trades bananas with Sweden, 84% of the time that transaction is being conducted in US dollars. That's the advantage of having the dollar as the global reserve currency. There was a bunch of noise recently. Saudi Arabia in China conducted an oil transaction in Chinese yuan. So people, the gold bugs, the Bitcoin bros, sounded the alarm and said, oh no, the dollar, the petrodollar is gone as we know it. Well, you have to look at the dynamics of that transaction. China is Saudi Arabia's #1 trading partner. China buys more oil from Saudi Arabia than anyone else. So it would make sense for the Saudi Arabians to go, yeah, I'll conduct this trade in your native currency. And that's exactly what they did. They were appeasing their best customer. Guess what the Saudi Arabians did with their Chinese yuan right after that transaction was completed? They immediately converted it to US dollars and held it in their treasury in US dollars. The stereotype of China being currency manipulators and intellectual property thieves is not just something that's being echoed here in America. The entire world recognizes that the Chinese manipulate their currency and they steal intellectual properties from other people. That's kind of their MO. And I'll say it again, it's taken 80 years for America to have this reserve currency status. I don't think we need to worry in our lifetimes of us losing that position. Now, in the year 2024, maybe only 80% of foreign trade is conducted in US dollars. But that's not something that's going to result in our quality of life being destroyed. When you look at the last two global reserve currencies, the British pound and then prior to them, it was the Dutch, like they still have wonderful qualities of life. This is something that you can take off your list. Not to mention, if you go down this rabbit hole, it always leads to dig your bunker and buy gold and ammo. And is there room to own gold and ammo? Sure. But if we were advising people to buy gold and ammo throughout the history of our firm, I can assure you we wouldn't have had the success that we've had, as those asset classes haven't performed nearly as good as some other ones. All right. We put a lot of weight in Vanguard's market outlooks. Now, the reason we do that is, one, I think Vanguard's one of the good guys. I think John Bogle, belongs on the Mount Rushmore for personal finance people. Just a wonderful low-cost investment chassis that anyone could plug into. Also, I find people to be a little bit more believable when they say things that fly in the face of what would line their pocketbook, right? So Vanguard's investment mantra is buy a good low-cost index fund and hang on for dear life. Buy and hold. And generally over long periods of time, the market will pop and it'll drop. But if you hang in there for the long haul, it'll work out well for you. This is their 10-year outlook on capital markets and fixed income markets. They only anticipate U.S. growth stocks. So this is Amazon, Netflix, Apple, Google, AI stocks, all those exciting companies that are changing the world that we live in. They only anticipate U.S. growth stocks to grow at 2.4 to 4.4%. In fact, U.S. equities, this value stocks are more like dividend stocks, consumer stapled names, 4.4 to 6.4%. This is the most bearish projection of stocks Vanguard has ever made over a 10-year time period. Charles Schwab echoed it. JP Morgan echoed it. Basically, all of the big asset managers are coming out and saying the same thing. They're saying, you shouldn't anticipate the same rates of return in the stock market these next 10 years as you've grown accustomed to the previous few decades. The market is not going to return that prototypical 7, 8, 9, 10% that Vanguard has projected in years past, and most people come to expect from the S&P 500. All of the big asset managers are issuing far less optimistic projections for U.S. capital markets. Take a look at this. Cash, this is money markets, commercial paper, things that could be converted to cash in very short periods of time. They project to make 3.4 to 4.4. So they're literally saying you're going to do better in cash over the course of the next 10 years as you will in U.S. growth stocks. This flies in the face of Vanguard's projections. I see a question here from Chris. What's their inflation projection? I can send you the whole report, or if you Google Vanguard's outlook, it's a lot more muted than the 5 or 6%. I think it's 3%. They give you an age range there, so a range. So if you Google that, you can pull up their most recent outlook. I think it's 2.5 to 3.5%. But don't quote me on that. Pull it up yourself and take a look at it. All right. So with all of that negative stuff, don't fret, celebrate. Now you're going, why would I celebrate? You just told me that the regional banks are going to go belly up. Inflation is going to continue to ravage the economy. And stocks are going to be terrible over the next 10 years. Well, this is a good pictorial. On the right side is an example of celebration. On the left side, that's my baby girl, Mary Kate. And don't behave like her on that first rite of passage sit on the sketchy Easter Bunny's lap. And certainly don't be like her brothers with their little deviant stares, watching her have to deal with that first voyage to the Easter Bunny's lap. Be more like Mike and Jackie over here, and more like Jackie and less like Mike. This is their twin gender reveal. And of course, Mike's got his two baby girls, Lily and Emma, and they're doing a twin gender reveal with the dual cannons. And this is the moment in time you see Mike firing his cannon. He sees nothing but pink. So in his head right here, he's going, great, I've got two baby girls, and I have another girl coming. Jackie, on the other hand, sees the blue. So she's like, finally, I can quiet Mike up about wanting to have a boy that I could teach all my gym class hero tricks to. If you fast forward this video a couple seconds thereafter, no doubt Mike is happy right there, but he gets just a little happier now that he sees that he's going to have a boy amongst the 3 girls. And of course, those babies have since been born and they're healthy and happy. And you'd never know it for a guy who has 4 kids, 5 and under. He seems to be happy as a clam, and he's a good mentor for me because Claire is being induced with our 4th kid on Friday. So Mike is my canary in the coal mine that you can actually live through this. But don't fret, celebrate. And here's why. This is a yield grid. And again, it's a little outdated. It's, we're talking close to 2 months old at this point, but the numbers haven't changed too dramatically. And I circled in particular U.S. Treasuries for 2 reasons. One, at the top, you'll see bank CDs. As a firm, we don't really want to go near the banks. Now, I agree with what Warren Buffett said. Warren Buffett made a wager. He said, I'm willing to bet $1 million that no depositor loses money in their banks this next year, because he's aware of the federal term bank lending program, and he knows that the banks have all been bailed out. So he's making a wager saying, hey, depositors, chill out. You're not going to lose any money in the banks, even if your bank folds up. I agree with him. I don't think anyone's going to lose any money in the banks. However, I've come to learn in my seat in this business, personal finance is about 80% psychology, only about 20% dollars and cents. And I don't want to be the captain of a ship that has financial instruments on it, that the financial institution that issued those instruments is on the nightly news because they folded up and the FDIC had to take them over. So as a firm, we are dissuading people from using CDs right now because you can get treasuries that are yielding better rates. And when you own a treasury, you're closer to the money's government printing press. Or better yet, fixed annuities that spread your risk across the litness of bonds and instruments. And you also have state guarantees, protections, which we can talk at length about how all of that stuff works. But we're avoiding CDs not because we think anyone's going to lose any money in them, but just because we're going to see more banks on the nightly news. And that is not going to inspire a lot of peace of mind in investors' bellies when they go to bed at night going, yeah, your bank folded up, but don't worry, the FDIC will make you whole. So we're kind of avoiding banks for that reason. But what you're looking at right here is the magnitude of how inverted our yield curve is. These are treasuries under 1 year with an average rate of 5.17%, 3 to 5 years, 3.44%. Over 20 years, you're at 3.85%. So you literally make more lending your money for 1 year than you would lending your money for 20 years. What do we do in this environment, right? So people are going, well, I should put all my money in 1 year treasuries because I make more lending my money for 1 year than I would if I lend it for 3 to 5 years or 20 years. And 9 times out of 10, if you ask an investor, do they want to buy a 1 year treasury making 5% or a 5 year instrument making 5.5%? They'll say, give me the 1 year. As investors, naturally, we're risk adverse and we're time and liquidity adverse. We want shorter term instruments rather than locking up money for long periods of time. Well, in an inverted yield curve environment, we've been spending a lot of time getting people a little outside their comfort zone, not too far outside their comfort zone. I'm not talking about making 10-year business decisions, 20-year business decisions, but in an inverted yield curve environment, it would behoove you to make intermediate term decisions. Think 3, 4, 5 years in length. Here are some fixed annuity rates. I wouldn't want to go near that B-rated company, but an A-rated company, 5 years, 5.25%. We're seeing 3 years, 5%. In my opinion, when you look at what Vanguard's guidance is on U.S. equities, only going to make 4 to 6%. When you look at the inverted yield curve, when you look at some of the other economic headwinds, and I have the ability to make 5% in a principal protected place for the next 3 to 5 years, that's a transaction that makes a lot of sense to us. The alternative would be, give me a 1-year treasury and give me 5% on a 1-year period. The risk you run by making the 1-year decision is 1 year from now, when you go to re-up that treasury, you may only be able to get 1 year's earning 3%. So that's what the yield curve is telling us right now. The yield curve is telling us 1 year from now, your 1-year treasury is only going to be making 3%. So with a yield curve as inverted as it is, a transaction that makes sense to us is a more intermediate holding period. Think 3, 4, 5, maybe as long as 7 years in many cases. The same thing holds true for linked accounts. Linked accounts include market-linked CDs, I-bonds, TIPS, fixed indexed annuities, the dreaded A word. This is an illustration for a fixed indexed account. We can send you the full illustration. I like what they did here, though. They basically show us the best 10-year time period, the worst 10-year time period, and the most recent 10-year time period. And you can see the worst 10-year time period ever with current rates at 11%, a cap at 11%. You're going to average about 6.6% per year over a 10-year time period, even when the market's not performing well. The best 10-year time period, you're at about 8.5%. Most recently, you're about 7%. So linked accounts are a way we can have kind of our cake and eat it too. We can have exposure to the market's upside, but if the market crashes, your principal is protected. We've been seeing having a lot of conversations with individuals about linked accounts because they're going, I don't feel warm and fuzzy about putting my money in the stock market right now, but I also don't want to put it all in treasuries. I don't want to put it all in CDs and fix things that give me no upside potential if the market does perform well. Take a good hard look at linked accounts. Refinance. Let me take a gulp of water here. So typically when you hear the word refinance, you think mortgages, because naturally when interest rates go lower, we refinance our mortgage. Well, when interest rates go higher, as we've seen over the last 18 months, it's an ideal time to refinance our cash, our CDs, our fixed accounts, our bonds, our linked accounts into a better position. Typically, when we refinance a mortgage, there is a cost to get your grass to the greener side, right? You have to pay a loan origination fee. You need to pay loan doc fees. You need to have your house appraised. You pay those costs because the grass is greener. You're able to get a mortgage with a lower interest rate, so you could pay off your mortgage quicker, or your monthly fee is lower. Same thing goes with your investments. Sometimes, if you have a CD that's only paying 2% per year, there might be a cost or a clawback to get out of it. But if we can get you into an account that's paying 5% per year, it is worth paying that see you later fee to go into the new instrument where you can now make 5% per year. So we've been having a lot of conversations with our clients going, hey, this account was the best thing for you 4 years ago or 5 years ago when we were in an artificially manipulated zero interest rate environment. Well, now that interest rates are at levels that are respectable, we can get the heck out of this thing. You'll have a little cost to get out of it, but the new account is going to offer you better growth rates. Another reason to not fret but celebrate, for the first time in my career, I'm seeing interest rates at reasonable levels that are higher than forward-looking inflation projections are supposed to be. Whereas most of you have spent the last 20 years, darn near 20 years, in an artificially manipulated zero interest rate environment. We're finally starting to see risk-adverse savers be rewarded with reasonable interest rates. For the longest time, risk adverse savers have had to almost take on more risk or do things that were outside their comfort zone in order to achieve reasonable rates of return. And then finally, I'll say potentially never have to speak to another financial advisor again. One of my oldest clients, not old age-wise, but old in her duration working with us, this is a lady who was on her money. This is a lady who would call me once a month. She watched CNBC, Fox Business, would say, hey, Adam, let's get out of growth stocks. Let's put it in dividend stocks. Let's get out of the long-term bonds. Put them in short-term bonds. What do you think about the emerging markets? How I want to put some money and put it in Tesla. This lady was on her money, and not a month went by. She didn't call me and talk about an adjustment she wanted to make to her portfolio. Well, she went back and audited the performance of her portfolio over the last 10 years. And she came back and she said, I've been making, just shy of 7% per year, which most of you would go, hey, I'll take 7% per year. But for that 7%, she was on Yahoo Finance daily. She was watching CNBC on the regular. She was losing sleep when the markets were choppy. She was stressing out about some of the predictions that she made. And when she started to catch wind of what fixed rates were paying, she locked in. I think she's locked in at a 5.25% deal, and it's scheduled for the 5.25% to actually get paid out to her on a month-by-month basis. The rule of thumb with retirement income planning is the rule of 4%. If 50% of your money's in stocks and 50% of your money's in bonds, you're supposed to take 4% out yearly, and you had a 99% probability you'll never outlive your money. Well, she now has an account that's principal protected that pays out 5.25%. So she made the business decision to take a chunk of her portfolio and say, I'm tired of tracking the markets. I'm worried about the inverted yield curve. I'm tired of worrying about my stock picks. If I got a bird in the hand and I can get 5.25% in a predictable way, that makes sense for me to take a chunk of my portfolio and put it in something that's going to be that predictable. So she made that business decision. And then I said, hey, I guess you don't need to call me once a month anymore. And she said, well, I'm going to keep calling you once a month because you've basically became like a family member. And who knows, you might have another kid in the next 3 months, which, by the way, is not happening. We will not be having any more babies, Claire and I. Anyways, you could potentially turn your back on the financial bean counter nerds of the world and the financial salespeople of the world by locking in a reasonable interest rate and kind of kicking the can down the road for a time. We love dividend stocks. Gosh, if you've tuned into any of my webinars, like literally I've used this slide for the last 3 years. Dividend stocks make sense to me right now. This is a long in the tooth slide. This is a Johnson & Johnson. And it just illustrates that when you own a dividend producing stock, you're not immune to paper gains and paper losses, meaning you're not immune to seeing your account value pop and drop. This is a chart that shows us Johnson & Johnson dropping 7%, then it goes up 30%, then it drops 21%, then it goes up 35%, then it drops 10%, then it goes up 15%, then it goes down. So if you had hundreds of thousands of dollars in Johnson & Johnson, you would literally see tens of thousands of dollars appear and reappear on a month-by-month basis. You're going to see your account value pop and drop. But when you own a dividend stock, you're less concerned about paper gains and paper losses, and your eye is more focused and fixed on these Ds that you receive on a quarterly basis. Those Ds are indicative of a dividend payment. Dividend investing is wonderful because if you spread your risk across enough dividend producing stocks, there is a level of predictability in the income that you are to receive. Now, that doesn't mean your account value won't go down. For instance, this is a dividend model we generated. The dividend yield on it now is pushing 5.8%. And we spread that risk across hundreds and hundreds of dividend producing and interest producing fixed income instruments and equity instruments. So Year to date, our dividend model, I think it's down a tick or it's flat. It's not performing as well as the S&P 500. That doesn't concern us per se, because we know our clients are going to continue to receive a predictable, stable dividend month in and month out and quarter in and quarter out. So we love dividend producing stocks. Dividends are always looked at as kind of a flight to safety. So if we are in fact in a secular bear market, you can anticipate people running to the exit here in short order. And as they run to the exit, where are they going to go? They're going to go to treasuries. They're going to go to fixed instruments. They're going to go to dividend stocks. So those are just three ideas that you might consider. I believe right now, heck, if your portfolio was made up of those three concepts, you don't really need to pay too much attention to the ticker tape, because you're going to be somewhat immune to market gyrations with those types of investment philosophies. And heck, if I'm wrong and we are in a bull market, you'll reap the rewards of a market going up by having linked accounts, by having dividend producing stocks. So all three of those investment theses are advisable, in my opinion, right now with all the economic headwinds and the fact that I think we are in a secular bear market. All right. Wouldn't be a financial presentation without a bunch of confusing numbers on slides. Usually this slide is activated by me clicking, so you're not supposed to see all the writing. But 37%, that's our current highest income tax bracket in this country right now. 1913, that's when the IRS was created. So in fact, people like to think like we beat the redcoats out of our country and we immediately enacted a federal income tax. We actually didn't have a federal income tax for 150 years. We had our first federal income tax in 1913. The highest bracket at that point in time was only 7%. Now, of course, we created the IRS in response to the Civil War and World War I. Turns out world wars are very expensive. In fact, when you look to our debt to GDP ratios at the end of World War II, our debt to GDP ratio was 119%. To put that in like Main Street American terms, if you had $100,000 income, we had $119,000 of credit card debt. How did the government respond to our debt to GDP ratio of 119%? Our highest tax bracket in response to this debt to GDP ratio was 94%. In fact, the highest bracket was over 70% for 30 plus years. 31, it's actually 32 now. We're $32 trillion in debt as a nation right now. Our debt to GDP ratio is 129%. 2026, this is when Trump's tax reform sunsets. The end of 2025, January 1st, 2026, we are going to have a new tax code. A lot of analysts are projecting that we're just going to do nothing at all, right? So we're going to revert back to where we were pre-Trump. So that means the standard deduction gets cut in half again. That means we're going back to writing off state and local taxes, our investment management fees, our charitable giving. I happen to think what will happen is they will cut the standard deduction in half again, but they're not going to let you deduct state and local taxes. They're not going to let you deduct some of the things that Trump didn't let us deduct. So undoubtedly, taxes are going up. Most of you, in fact, all of you, have lived in a world, an income producing world, when you actually had good income, where taxes have been on sale. And we almost forgot where tax rates were in the 1950s and the 1960s in response to World War II. Our lowest bracket, right now our lowest bracket is 12%. And of course, that's after you get your standardized deduction. And of course, different income gets taxed at different rates. For instance, Social Security income has its own progressive income calculation. But our lowest bracket right now is 12%. Back in the 60s, our lowest bracket was 20%. 1950s, it was 17%. Our highest bracket, you can see 83%, 91%. I happen to think tax brackets are going to be shooting up dramatically. Now, the government, if there's anything we could, predict them to do, it's do whatever it takes to get reelected. So I think they're going to tax us in more progressive ways. Who's the easiest person to tax? A dead guy. They'll probably mess with the estate tax. They already are messing with it with the Secure Act and the Secure Act 2.0, where multi-generational IRAs now need to be exhausted in 10 years. They're doing a lot of shaky, sketchy things. But I also do hold out hope that smart money people, smart tax people will always be a step or two ahead of the IRS. And the IRS is kind of preying on the complacent, preying on people to not make adjustments within their tax and their investment plans. Next generation planning. I love this slide. On the left, that's my wife's grandmother, Mary Menifee, on her 100th birthday. And on the right, that's my baby girl, Mary's namesake, Mary Kate, 18 months old. So a 99-year age difference in this picture. Mary Menifee grew up on a tobacco farm in North Carolina with sharecroppers. Mary Kate is going to grow up on Daniel Island, the land of yuppies, with a gadget glued to her hand. So very different worlds the two of them are going to experience. But the reason I show this picture is to illustrate as a firm how we're evolving. Some of you might recall I was eager and anxious to add a tax preparation component to our firm. That kind of fell through. And I'll tell you the reason why I've been very trepidatious to move forward with that. If we make a promise to you all to sign your tax returns, my ideal working relationship is 2 lifetimes. So if I say, hey, I'm going to do your tax returns, I can't hire someone who has a midlife crisis and decides to leave 2 years from now, leaving you without a tax preparation firm. So I continue to look for that relationship, but I probably won't be implementing that until I find someone who is loyal to the point they're willing to name their firstborn son Adam, which I know might be difficult to find, but that's the type of relationship we're looking for. If we're going to make a promise to you, we better deliver on it, and we can't be blindsided by someone, jumping ship and doing something different with their life. So what we want to do is everything it takes to get your tax preparation and tax planning done, but sign your return. So what you're going to experience from us ongoingly is we're going to want to have tax planning visits where we talk less about your portfolio and performance and more about your tax return. And we'll leave you from these visits with a hit list that you can hand to your tax preparation person that just simply says, hey, we're advising you to do qualified charitable distributions from your IRA. We're advising you to fund a donor advised fund. We think you should make a spousal IRA contribution. And then you can literally just hand this to the person who scrubs your tax return. And then better yet, take it another step and give that person our name and ask them to call us. And then we can speak Greek and ensure you're taking advantage of the law the way it's written and receiving every credit, every deduction above the line, below the line. And you're just, flexing every single option at your disposal so you don't pay a red cent more in taxes than you're legally obliged to. More and more, we're seeing our clients liquidating their business, selling real estate that was highly appreciated that they no longer use. Think the beach house or the house up in the mountains. People are becoming more charitably inclined. If you know me, my whole shtick is, hey, spend your money. You only get one life. You don't want to be the wealthiest person in the cemetery. More often than not, we're twisting people's arms, telling them to spend their money, and they're just not going to be able to do it in 2 lifetimes. So once people come to grips with that, then they go, all right, well, how do I give this money to my children, churches, and charities in the most tax efficient way? So we get into long-winded conversations about charitable giving and maximizing an estate. We have some resources now that you should lean into us. So if you're contemplating selling your business or liquidating a highly appreciated real estate, don't only just speak to your business broker or don't only just speak to your realtor. Talk to us, because there's some things that you might want to do in advance of that transaction that's going to save you a ton of money in taxes when it comes time to sell that thing. Estate maximization falls into that same. Anytime we can give money marching orders well in advance of its end use. Like, so if you know darn well, Adam, I got $300,000 that I know darn well I personally am not going to utilize in my lifetime. This is money that I want to earmark to go to my kids or my church. If we earmark that money well in advance, we're able to maximize those dollars for charitable intent. So we want to be looked at as a resource, not only for your investment planning and your retirement planning, but for taxation and estate planning and even as a resource you can lean into when it comes time to selling a business or selling a highly appreciated piece of real estate. Healthcare falls into that very same concept. A lot of people don't know we can help them with their Medicare decisions. When you turn 65, your mailbox gets littered with postcards saying, call me and do this and do that. And sometimes that can be a very confusing season in life. So we want to be a resource for you here. We can help you with your Medicare Advantage and Medicare Supplement decision-making process. It's really a revenue neutral pursuit in my office. We don't make any money off of it, but we can independently shop all the different carriers for the very best rates for you. We can teach you the difference between Medicare Advantage and Medicare Supplements. And that just gives us an opportunity to kind of be an even greater resource for you all as those difficult decisions come up. All right, finally, in closing, we have a saying in my office, and that is, we are not an easy place to work, but we are an excellent place to work. This slide right here, some of the people in those pictures, we've got new people. Some of those people have moved on to greener pastures. There's a labor crisis happening in our country right now. In fact, I saw there are 7.2 million able-bodied men aged 25 to 55 who are electing to not work. So these are people that aren't even factored into our unemployment rate. I think our unemployment rate in this nation right now is actually negative, meaning there are more job opportunities than there are employable people willing to do the job at hand. Words like quiet quitting, the great resignation, now it's turning into the great resentment. So the great resignation, 23% of Americans quit their jobs during COVID. Quiet quitters, these are people who just didn't have the gall to quit their job, so they just kept getting a paycheck and not doing the job. We have a saying in our office, quiet quitters are greeted with loud firing. So I'd like to say we're immune to this because we have such a wonderful culture, but that's just not true. We've experienced turnover. We've experienced the quiet quitter. We've had people, take their issues from home and bring them to the office and blame us for their home life issues. And look, not pointing fingers at anyone. Life is hard. But the point that I want to make is, so long as my name is on the door, so long as I am kicking, our little company will not be a victim to the American labor crisis. I refuse to put a sign on our door that says, please be patient with us, we're understaffed. I refuse to surrender to this idea that people go to a job and behave 3 rungs below mediocre and go through the motions in order to, just get by. So my pledge to you as the owner of this place is just to not tolerate mediocrity, continue to operate an organization that returns calls, operates and executes at an excellent level. And if you guys ever sniff out a lack of attention to detail and excellence, please let me know personally. And I will banish it and flush it out of this place like the plague that it is, or coach and train up those individuals. The group of individuals that we've assembled, I think, gravitated to us because they still believe that traditional, hardworking American values will rule the day. They don't want to work with slouches. They want to look down the hall or down their desk and know that the person to their left and their right is laying it all on the line and executing at a high level just like they are. So tip my hat to the folks who gave our company a pound of flesh. We have found some excellent ones, people that you're going to read about decades from now as they put their dent in the investment world. And also thank you for bearing with us as we train new hires, as we experience turnover. I know, like I said, we're not immune to it, but we're not tolerant of it either. And I hope you guys see that in your day-to-day dealings with our firm. So thank you all so much for putting a little trust in us. Any questions? Let me see. Avoid Medicare Advantage plans at all costs. I'm a SLP in long-term care. Happy to advise anybody. Okay. So yeah, there's advantages and disadvantages with Medicare Advantage and supplements. Medicare Advantage is cheaper, of course, but I won't go into all of that. Hello. Guys, thank you so much for being a part of our little presentation. Any questions, feel free to direct them to our office, and have an awesome day, guys.